Alright guys, welcome back to episode number 6 of the Living Off Charts private mentorship. This episode is still going to be going over high time frame bias, and we're going to be using the previous 5 episodes and we're going to be putting it all together as well. So if you haven't watched the previous 5 videos, make sure you watch them first, because some of the topics in here wouldn't make sense. So go back, watch them, and then get into this video, because this one's going to be a game changer in terms of high time frame bias and determining the next quarter's price action. All right, what do we focus on? As we always do, time and price, right? So on the higher time frame charts, how do we delineate time? It starts off with quarterly shifts, seasonal tendencies, and the opening price for the open high low close or open low high close. Price, market profiles. This is going to be 70% of your analysis is going to take place market profiling. Premium and discount, external and internal range and liquidity, and a liquidity rate. Our objective is to blend time and price. What are the 4 market profiles? And you guys should know this by now from the episode number 2: consolidation, expansion, reversal, and retracement. A market profile will only change at a key time. So a market profile will only change at a key time. What does that mean? A key time is going to cause a change from one of these market profiles to another. This does not occur randomly. It occurs at a key time. We don't change from expansion to retracement randomly. It only changes market profile, changes the state of delivery at a key time. What is the key time on the higher time frame charts? It's a brand new quarter. The previous market profiles in the segment of time defined by a quarter aids in our analysis to predict the next quarter's market profile. So we're not just going to be putting a vertical line on our chart come a new quarter and look forward. We have to look back at the previous quarters, see what that specific quarter did to determine the next quarter. We look at the market profiles within the previous quarters and we try to determine which market profile will be coming up next in the current quarter we're going to be trying to trade. So here's a schematic of what it could look like, and this is going to be very familiar to you guys if you've watched episode number 2. So this would be a yearly candle. Okay, so the same way on a daily candle we'd be looking for an accumulation in Asia, then a manipulation in London, and an expansion in New York. We'd be doing the same thing in the quarters, and as we use Asia's range to determine London's price action, we're going to be using a previous quarter's range to determine the next quarter's market profile, which is a new stage of distribution or accumulation, or it could be a reversal. Now, how do we analyze and what do we look for? Premium and discount. We only short a premium and we only long a discount. A new quarter, market profile, the opening price of the quarter, and a key level for the quarter to trade off of. Now on your chart here, you have a DXY monthly chart. We have a discount low here and a premium high here. This is the dealing range. We're going to be looking for a key level in discount if bullish. It's only a key level if it's in discount. So we have right here, as you can see, a fair value gap here. You can see price trades down into this FVG in discount, and then on a daily chart we're going to drop down lower here, and we're going to be looking at a few things. We're going to be trying to profile the market here, determine the bias, and make sure we are in a correct IPDA market cycle for the next upcoming quarter. And we can determine that by looking at the previous quarter's price action. Now, when you're looking at a daily chart like this, it can be kind of confusing to determine how are we going to do this. But this is why we need to break up the charts into quarters for the previous quarters, and then look at the next upcoming quarter. We're going to now put the quarters on here, and this is where trading and higher time frame bias becomes mechanical. So what you're going to try and do here is look at the quarter here, determine the market profile in this segment of time defined by a quarter to determine the next upcoming quarter's price action. So as we can see here, we have January till April, Q1 and Q2 actually being a consolidation market profile. So what follows a consolidation? Expansion. We're also in a key level below the opening price in a discount on the higher time frame dealing range. So once we have this analysis and we're like, we can trade off this monthly discount FVG, does the previous quarter's market profile validate this idea? Yes, it does, because it's accumulation. So we have a manipulation and distribution. And I'll give you guys a tip here. When you have two previous quarters with the same market profile, you can anticipate the very next market profile, quarters market, to be very parabolic and one-sided with very little retracements. As you can see on the dollar, it basically goes up in a straight line. So in the new quarter, what are we going to be doing? We're going to be market profiling. We're going to be looking at a key level to trade off in the new quarter. We're going to be trying to long below or short above the opening price of the quarter. We need to see an SMT to confirm smart money is accumulating or distributing. We're going to be using an IPDA look back from the new quarter, looking backwards at 20, 40, and 60 days to determine our draws on liquidity. And then we're going to be looking for a lower time frame range to trade off of. So in the new quarter here, that's this right here, this is July, we run below the previous quarter's low into a key level below the opening price with a consolidation market profile as the previous market, with a consolidation market profile in the previous quarter, the previous past two quarters here. So then we trade below the low here, below the opening price, and then we look for a lower time frame range to trade off of. So this is a valid idea for this quarter's price action because of the consolidation here, and you should be anticipating this because of episode number 2, where we go over how price delivers, the IPDA's market cycles. You can know which market profile is likely to occur in the next quarter. So lower time frame range here on the daily chart from our monthly key level with valid market profiles. We trade below the lows here, below the opening price. Price trades higher, displacement here, fair value gap here, and price continues to move higher. But now we need a SMT to have strong confirmation that smart money is accumulating longs. When we have that SMT on the daily time frame is when price really starts to kick off, and you can expect very little retracements and big parabolic price swings coming into the market. On the DXY, we've hit a key level, the discount monthly FVG. We have a valid previous quarter's market profile for longs, the accumulation. And then on the bonds between the 30-year, 10-year, and 5-year, that's the bonds triad, we have an SMT here, new quarter here. We trade above the quarter, we expand lower, then we retrace here. And then we have an SMT with the 10-year, 5-year, and this is the 30-year. This is 10th August right here, and we're going to look at DXY. 10th August is right here. So as the bonds have a triad SMT in a new quarter, with DXY having a key level, previous market profile being valid for a bullish market profile this quarter, and we have the SMT that is a very, very strong signature that we're gonna see big expansions. So right here, price trades into a fair value gap here at 10th August. You can see the low is made where this high right here is made on the bonds triad SMT, and then price hits the fair value gap here and just continues trading higher until we take out the lower time frame range here on the daily. That was right here. This expansion here was that daily. Now the very next quarter, after having 2 consecutive quarters of accumulation, we had a very parabolic bullish expansion here from our key level, and then a new quarter kicks off here in October. This is Q4, and we see price trade lower. Why is this valid here? IPDA's market cycles, expansion can go to retracement. So we change the state of delivery from bullish to bearish, aka retracement here, at a key time, which is the new quarter. Price then trades down into a key level right here in a discount, and then we see the next market profile in the new quarter being bullish here. The open is here, the close is here. This is a bullish expansion. So we go from expansion, retracement, expansion here. What happens after an expansion? A retracement or a consolidation? This market profile was already a retracement here, and we had an expansion. after an expansion here, so we could anticipate a consolidation. Usually it's very hard to anticipate price action consolidating for 3 consecutive months. This is the only way you're going to be able to do that and anticipate this kind of movement in price, is when you break down price into segments of quarters and look at the previous quarter's market profile to try and determine the next market profile for the upcoming quarter. And you can see price then did end up consolidating for 3 months here. This is the open of the quarter, this is the close. It stays within this range here. Now zooming in on the daily chart here, this is that expansion that we went over. This is the retracement market profile, valid because of the expansion. Trade back down into our key level, which was that weekly FVG. That's this right here. And then we have a new quarter kicking in. Price then starts to expand. It's valid because of the previous quarter's market profile, retracement to expansion here. Quarterly open here. We trade below, fair value gap here. Price then trades higher. We have a retracement here, long opportunity again, volume imbalance here. We're expecting expansion to occur. We expand into the close of the quarter. Then a new quarter opens and we see price go into a consolidation for the entire quarter. Now let's put it all together. This is going to be putting together everything we've just gone over right now, as well as the previous 5 episodes to come to a conclusion, to come to a bias for the quarter, the weekly candle in that one shot, one kill, and then using IBDA's 20-day day trading to find a entry on the daily charts and find a one shot, one kill to trade off of. And remember guys, I got that FTMO funding account, both of them, that got me max funding, only trading one shot, one kills. And this is exactly how I did my analysis to determine that. Here's the move called in the Discord group by the OTE trader. You can see we're calling shorts on US oil, and we're going to go over that exactly why we had that bias. It wasn't only a one shot, one kill and a weekly bias. We actually had a high time frame low that we were looking for, so price was really moving forward down to that low. The weekly chart here, dealing range low here, dealing range high here. Everything above this is a premium. We have a weekly fair value gap here in premium, so this is our key level to trade off of. External range liquidity here, so internal to external. Now zooming in here on a daily chart, we have a lower time frame range with this high and this low into the key level. So we take a lower time frame range high here to range low. We take the high here with SMT here. There's SMT with gasoline futures. That's the SMT you use for US oil. And then price starts to trade lower. In this new quarter, we're going to be looking at market profiles, a key level, the opening price, SMT, IBDA's look back, and the lower time frame range, which we just went over. So price is broken up into quarters here. This quarter is a bullish expansion quarter. The very next quarter, we see price trade lower, and then we have a retracement here, back up into a premium weekly fair value gap. That's our key level. And then we can anticipate a bearish market profile for the upcoming quarter, and we can determine this using the previous market profiles in the previous quarters. Price then trades up into the weekly key level here, new quarter open, key level above the open. What are our liquidity pools for this key level to trade down into? We're going to be taking the day of the new quarter. We're going to be counting back with the first day being the day before the new quarter, which is right here, 20, 40, and 60 days. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So clearly this is the 20-day low, 40-day low, and 60-day low, as this is the previous 60 days. Usually you wouldn't have this signature of 20, 40, and 60 being the same. However, in this case we did. If you had a 20, 40, and 60 being different, you would mark both those lows as a potential drawn liquidity for the new quarter. Now once we hit that key level, we have SMT here with gasoline futures. We run a short-term high here, then price trades lower here, swing low here, broken through. We leave a volume imbalance, and now we can see price respecting these bearish fair value gaps here, So the bearish PD arrays are being respected because we switch market profiles here from bullish here to bearish here. So this right here is an expansion market profile. Fair value gap here holds, trades lower into the 20-day low. We have one more run higher into consequent encroachment, 50% of this FVG, before one last run lower for the sell side liquidity. And this is actually the move we called in the Discord group here. Now looking at the previous day high runs here, right there, and we have a previous day high run here on gasoline futures. So there's SMT here. Now if you remember in the past episodes, I talked about previous day high runs in an IPTA 20-day look back for day trading. So when we're looking for high time frame liquidity pools to target for our bias, we'd use the look back from a new quarter. So this would be our liquidity pool to target. However, when we're trying to execute intraday and find an entry, we need to be in a premium of the day trading IPTA's 20-day. That would be from the day you want to take a trade, the day before you'd count back 20 days. So that would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So this is the 20-day low. This is the 20-day high from the day before we want to take a trade. It's in a premium clearly here. So this is valid. This right here, another previous day high run here. It's also in a premium, obviously. And we can see price trade above that and then big expansion down. This right here is how we would catch our one shot, one kill. And this is exactly the analysis and the protocol I did top down to take those one shot, one kills that got me max funding on FTMO. So looking at this, these red rectangles right here are the daily fair value gaps. And we can see price on a 4-hour have a CSD here at the key level. This is the new quarters open as well, right there. Fair value gap here, which price trades into. This is that daily FVG again, the second one. Price trades up into it, closes below the up close candle. We know we're bearish because of the market profiling with quarters. And then we have a CSD OB. Now, putting on the weekly opening price here, because a CSD only occurs above the open if bearish and below the open if bullish. So price trades above the open here for an open high low close. We're anticipating open high low close candles because of the market profiling with quarters. We have the CSD above the open, trades lower, price comes back above the new week open here, trades lower here. CSD above the weekly open, that's a short here, this is a short here. This here is enough if you enter here with a stop above here and enter here with a stop above here. You do not need to drop down to 15, 5 or 10 minute time frames to catch a trade. This is literally all you need, and this is exactly what I did to pass the 2 challenges on FTMO and get max funding. Now the last trade, which is this daily FVG right here, let's go back so you can see, that's this right here, this FVG right here, which is the one we called in the Discord group, is that right here. This is the 50% of that fair value gap, SMT at the key level above the weekly open, then price trades lower, CSD with this FVG here, so the up close candle, and this right here we trade below. That's our CSD here. Then we can see price respecting up close candles here. Bullish order flow has kicked in, bearish order flow has kicked in, and then we come back up one more time, monthly open as well, into the now IFVG before a sell-off here. And I believe Tom called 3 or 4 trades in here on this expansion down. And we had this bias and this analysis because of the educational you guys are watching right now. This is how we came to the conclusion that price would be bearish. And you can see the price movement on the way down. Big moves down, we're even gapping down. So this is the kind of market you want to position yourselves in. And you're only going to be able to find markets that are expanding in one direction if you know the key times, which would be the quarters, and what price did in the previous quarters. That's the only way you're going to be able to do this with a mechanical approach. Now, if you guys enjoy this video, leave a like and a comment, as well as if you guys want a 7-day free trial in the Discord group where me and Tom trade live 5 times a week and call price before it moves. There's a free trial in the description below, so you can click the link and I'll catch you guys in the Discord group.